Washington is dark and the data is gone, but markets are still moving. In today's Truth Bomb, I'm showing you how to read the economy when the government can't even turn the lights on. The signal is out there. You just have to know where to look for it. On today's Into the Grinder. Washington, D.C. press rooms are sparkling clean and the lights are off. We're now in day 24 of the government shutdown and the market is dealing with a complete data blackout. The data blackout appears, barring a few exceptions, to be here to stay for a while as the Senate plays a game of chicken to see which side flinches from the pain first. 12 continuing resolution votes have failed to turn the lights back on. The Fed is still active, though they don't deliver any real data except for the hot air bestowed upon us by its FOMC members on the regular. Those members, well, they'll be voting on interest rate policy next Tuesday and deliver one of the most important market data points of all. Rate cuts now and the possibility of future ones. We'll find out what they're going to do next Wednesday. But today and this past week, the usual chatty Fed is in a press blackout leading up to next week's big FOMC meeting. So we're still flying blind. And so is the Fed, for that matter. Earlier this week, I posted some videos on the importance of following earnings closely as a source of real and possibly even more important economic information. Well, we've had almost a full week of earnings, just about 30% of the S&P 500 reporting so far, but near nothing from official government sources. So where are we? Let's start with some of the most important drivers of Fed policy. Really, there are only two: inflation and unemployment. That's it. This morning, we finally get the delayed consumer price index, the CPI, from the Bureau of Labor Statistics. The Fed prefers the PCE price index, but in a shutdown, something is better than nothing. Consensus expects headline inflation to have ticked up to 3.1% from 2.9%, thanks to rising energy costs. And you can't forget food prices. Core inflation is expected to remain flat at 3.1%. My friends at Bloomberg Economics expect the number to be slightly cooler. If you're hoping for a rate cut, you want cooler, or at least consensus. If it comes in hotter, well, all bets are off the table for December. Futures still price in about a 90% chance, but that can vanish in a flash. It's not likely that the Fed, though, will change its apparent path in a data blackout. But December is a completely different story. Lots can happen between now and then. The delayed CPI print will be today's star of the show. And yes, it was prepared before the shutdown, so no shortcuts there. And that number, it was just out. And guess what? Cooler than expected at 3% for both core and headline. I'm going to dig into that a little bit further in my weekend wrap, so be sure to check out that video. We're also going to get some private economic data today that will be more scrutinized than usual because it's all we've got. The University of Michigan will release its final monthly revision of sentiment index, expected to be revised slightly down. It's been drifting lower all year, and that matters because why? Because consumers drive 2/3 of GDP. And you know my favorite slogan, confident consumers consume. S&P Global's U.S. Purchasing Managers Indexes, the PMIs, are expected to show a slight drop in services with no change in manufacturing. PMIs are corporate sentiment, and companies, unlike consumers, don't just talk about confidence, they act on it. They invest, they hire, and sometimes they fire. So let's talk about that other Fed driver, employment. Remember, the last official data we have only goes through August. September's job report was never released. The 4 prior months all came in under 100K, clearly declining. Private employer data from ADP showed job losses for a second month in a row, and the weekly jobless claims we usually rely on also gone dark. Thankfully, my friends at Bloomberg Economics compiled what data they could dig up and estimate last week's number, and it was around 227K, which is pretty much in line with early September levels and below the 4-week moving average of 237K. That's a bit of good news. Stability in the face of uncertainty. But look around. Companies are talking about layoffs, a lot of them. And last night's Target announcement was a bombshell. 1,000 corporate jobs cut, 800 vacant positions eliminated. Bam! Look, the 1,000 jobs won't break the labor market, but it's a signal. Target has been struggling with bad management decisions, soft demand, and higher input costs, some of which may be tariff related. And here's the bigger story. Margins. Retailers are under massive pressure. Many can't pass cost increases to consumers because prices are already too high. Once pre-tariff inventories sell through, we'll see margins squeezed even harder. Target reports next month, and it's expected to show declines in both earnings and revenue growth. So how's earnings in general going so far? Well, with 144 S&P 500 companies reporting so far, earnings have beaten by an average of 7.8%, sales by 2.4%. That's good, but below last season's 12.8% and 6.3% respectively. So far, reported earnings growth is 15.5% and revenue growth is 7.8%. That is better than expected, and EPS growth is ahead of last quarter's 12.8%. Investors are responding more positively to beats than last season, which means expectations were low. The bar was set low and companies are clearing it. So where does that leave us? Well, somewhere between cautious and confident. Things aren't falling apart, but we can't claim victory over inflation or uncertainty just yet. The real story of this shutdown won't be how long it lasts, but how investors learn to navigate through it. Every earnings call, every PMI print, every sentiment index is a pixel in the bigger picture, a picture that's still coming into focus. All these data points are now in the grinder. But remember, grinders don't just crush, they refine. The next few weeks will separate signal from noise, companies with real earnings power from those running on narrative alone. So stay curious, stay skeptical, and don't let the silence from Washington fool you into thinking that nothing's happening. The data may be missing, but the story is still being written in quarterly reports and checkout lines and factory orders in every whisper of the economy. The lights will eventually come back on in Washington. They always do. When they do, though, we'll get our deluge of reports, revisions, and charts. But until then, we'll keep doing what we always do. We'll read the tea leaves, we'll follow the clues, and focus on what matters most: earnings, employment, expectations. Washington may be dark right now, but the market is still illuminated by what truly matters. The headlines are quiet. The charts, they're missing, but the economy is still talking. You just have to listen in different ways. So, your truth bomb for today is this. Even in a data blackout, the signal is still there. You just have to know where to look for it. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.